Good day, ladies and gentlemen, and welcome to my channel. Today is January 15th, 2021, and I would like to discuss in this video major macroeconomic trends in the US economy for the coming years. Let's start with the US bond market. This is a 30-year US bond futures, which has been in a 40-year mega bull market. As bond prices has been rising, yields have been falling, since bond prices and yields are inversely correlated. US bond yields peaked in 1881, rising as high as 15.6%, and since then has been in a bear market, falling as low as 0.32% in July of 2020, and presently standing at 1.1%. Recent increase in yields suggests that investors are pricing in higher inflation and expect US Federal Reserve to hike interest rates. Historically, US Fed hiked rates to cool off the economy and keep the inflation under control. However, in my opinion, this time Federal Reserve will not be fighting inflation, and here is why. Over the last 40 years, US M2 money supply, which includes cash and savings deposits, increased 12-fold, from 1.6 trillion to over 19 trillion. Interestingly, US M2 money supply, which averaged 5% annual increase in the past, accelerated increase in the recent years and rose by a record 25% in 2020 only. Meanwhile, during the same period, the US federal debt increased 27-fold, from just under 1 trillion to 27 trillion US dollars by the end of 2020. Whilst US GDP increased by a little over 6 times, from 3.2 trillion to 21.2 trillion US dollars, the US debt to GDP ratio, which stood at 31% in 1981, is presently standing at 130%. To sum up, to grow US GDP by 6 times over the past 4 decades, the US debt increased 27-fold and M2 money supply by 12 times. If we plot these numbers on US bond yield chart, we can see the following. In 1981, US GDP exceeded US debt by a little over 3 times, and rates were in double-digit area. 20 years later, in 2001, US GDP exceeded US debt nearly by twice, and Fed could only hike rates as high as 5-6%. By 2021, US GDP fell behind US debt, leaving little room for a rate hike. As such, interest rates remained near 0%. With worsening debt to GDP ratio over the past 40 years, Federal Reserve had less room to hike interest rates. Every 1% hike in interest rate against present 27 trillion debt, which keeps rising, would roughly add an additional 270 billion in interest rate expenses. Therefore, if central bank had to increase interest rates to 3-4%, that would increase US budget expenses by an additional 1 trillion in a single year. Exactly for this reason, Federal Reserve would refrain from hiking interest rates in any meaningful way should inflation start to pick up. Technically, Fed could hike interest rates, but that would significantly increase US budget expenses, accelerate the growth of federal debt, and put immense pressure on heavily indebted private sector. Trying to curb inflation by hiking interest rates will be much more costly. Therefore, any attempt to normalize rates would be unsustainable. Therefore, I believe that instead of hiking short-term interest rates, Federal Reserve will be buying a long end of the bond market to keep long-term interest rates suppressed for as long as possible. Ultimately, I believe interest rates will remain at very low levels over the next 12 to 18 months. Rising inflation and suppressed long-term interest rates would be an ideal environment for the entire commodity sector, most importantly for the gold and silver. This is it for today. Please note that this video is not an investment advice and prepared solely for educational purposes.